Sounds good.
Yeah, okay.
See you there.
I'll be there.
And we are recording.
Awesome. All right.
Cool.
Jorge, do you want to just kind of mute everybody to begin
Yep.
with?
Go ahead and mute everybody. 1 second. Give me 1 second here. All right, so I just went ahead and unmuted you.
All right. Hey, what's going on, everybody? Hope you are safe and well out there. Thanks for joining us today. Part of our MFM Multifamily Masters virtual discussion with Juan Vargas. We're really excited to have him today. Share some of the experience on what's going on with the current multifamily market. I'll be joined with, so I guess mission statement, once again, we're grassroots global community here to connect, educate, and empower people to build wealth through real estate, which many of us have are really thriving right now. So disclaimer, once again, what you learn here is not legal or financial advice. So make sure that you consult with legal and professional on any specific situations. If you have questions, what you learn here is primarily for entertainment purposes.
And
really quickly, the schedule. So just kind of jump through this. Number one, quick announcements that we're taking care of right now. Afterwards, we'll have Juan speak for about 45 minutes to an hour, over 1,500 units of experience. And the next meetup, we're tentatively going to put up Tuesday the 26th, either a virtual or a physical meetup, but most likely virtual with another speaker. And other quick announcements. So we're going to be doing this regularly. Once again, fourth Tuesday of every single month. Last month was a unique situation. And we're really doing this to help continue to educate. This is one of the most important times to build up your education so that you're prepared to potentially jump on opportunities in the future. So thanks for joining us. Really quickly, who we are, I'll let Jaime speak first. Or maybe Jorge can jump in here.
cool. And just to make sure, Jaime, are you unmuted? Are you all good to go on your end? Okay. You should be unmuted. There you go, Jaime. You should be good.
Perfect. All right, thanks, Jorge. So my name is Jaime Sanchez. I've been a real estate developer and investor for over 12 years. Been working on different types of projects from, residential all the way to high-rise type developments throughout my career. And I'm currently working on one in downtown LA, as well as a mixed-use 53-unit apartment building. My expertise in the multifamily space is being a passive investor. Been investing in over 1,200 units in Texas. And I'll pass it over to Jorge.
Hey, what's up, guys? Good evening. Jorge Contreras here. Very excited to have every single one of you. This is our first virtual meetup. We normally host them in person, but excited to have you all here. I've been in real estate for about 12 years myself, mostly on the single family 1 to 4 units. Currently, myself and Jaime also have a short-term rental business with over 15 Airbnbs here in Southern California. I am passive in about 1,200 units, also in the Texas area. And yeah, very excited to have you guys all here. Go ahead, Kevin.
All right. Hey, sorry about that.
No worries.
Muting goes one way. So my name is Kevin Dugan. I've been one of the chapter leaders here in the West LA for about 2 years now. 8 years of real estate experience, built a real estate company in Chicago that comprised of a property management component, construction side, and investment arm. And I've GP'd in 200 units in Texas, LP'd on about 200 units in Arizona, and really big on just providing value and building up that community. So we're here today to help out. Please be interactive. Ask as many questions that you have regarding what the current climate is. Please put them in the chat so we'll be able to circulate those later on towards the tail end and even throughout the discussion. So we'd love for you to contribute and ask what's on your mind.
All right, everyone, without further ado, I'm going to go ahead and introduce our guest speaker, Juan Vargas. He'll talk a little bit more about himself, but I just want to kind of quickly introduce. I met Juan last summer. We were at a real estate event and we hit it off right away. And so we've constantly been bumping into each other in real estate events, probably once or twice a month prior to this COVID situation. He's been really helpful in kind of his expertise in the multifamily space, especially in the Texas, Arizona markets. And he's more than willing to educate folks about what's going on in the current environment, how he's navigating through the process. So really, really happy to have him on. So, I'll go ahead and turn over to you, Juan.
Yeah. So thank you very much. Let me know, guys, if you can hear me. Hopefully everybody can hear. But yeah, I want to thank Jorge, Jaime, and Kevin, all three of you guys for the invitation. I really do appreciate that. It means a lot to me to be able to share my story and to be able to, help out anybody out there that's, has any questions, that's looking to understand how it is to get into multifamily, what's going on in the multifamily space right now, what we're doing currently because of COVID-19. And then not only that, but what we're doing as far as underwriting for new deals, right? So it's all very important. But so a little bit about me. I'm based in Houston, Texas, born and raised in Texas, just outside of Houston. And so, I've been in real estate in multifamily. So I started in multifamily in 2016, but I've had, a little bit more experience than that, about 8 years in the single family space as well. So currently we have 55 million of assets under management, which is spread over 700 units. In addition to that, I've been a general partner in another 577 units and a passive investor as well, where, we put up equity into other guys' deals. And these are colleagues, these are friends who have, good, strong track records, who I feel comfortable with in investing in their deals, right? Together as a team, we've raised 21 million in total equity for our deals. And, next bullet point there is, I'm founder of Gen Wealth Capital Group. I'm also a host of a podcast called the Commit to Wealth podcast. And I've had guests such as Robert Kiyosaki, Grant Cardone, a bunch of other, guests out there. But, those are probably the most popular, the most known guests. And then I'm also a co-host on a Spanish one. So it's all Spanish, 100%. And it's called El Cash Flow Café. I'm bilingual, speak Spanish. And, this is, like I said, it's a Spanish entrepreneur podcast. It's not just in real estate, but, it has a bunch of different, it's basically cash flow, right? So a bunch of different sectors there. So, yeah, that's a little bit about me. And then, yeah, we can go to the next one.
Cool. Well, so Juan, tell us a little more about your experience, some of the most recent deals.
Yeah, for sure. So this is one of the last 3 deals that we've been a part of. So this one's called Tesoro at 12. It's a 184 unit in Dallas, Texas. It's a purchase price of $15.25 million. Fannie Mae and Freddie Mac are the 2 agencies that we usually work with, or the only 2 agencies that are out there, but those are the ones that we usually go with. So this one happened to be a Fannie Mae. It was a loan assumption, which means that we are taking over somebody's loan, right? So we're assuming the loan, and then sometimes the equity that's needed is a little higher, so we can get a supplemental. So this is like a second loan that's, in addition to the assumption. So in addition to the primary loan, there's a secondary loan that goes with it. That's called a supplemental. So that's what this one was. And then, so approximately it was $5 million in equity raise. And this is a value add opportunity here. Projected overall returns are 100%. And a little over 9% cash on cash. So 100% meaning that you're doubling your money, right? So 9% cash on cash is, per year, if you put in, 100,000, then 9% meaning that you'll get about $9,000 back on an annualized basis. Another deal here is the flats at 2030. This is a deal that we closed on in August of 2019, 236 units, purchase price 16.7. This is a Freddie Mac. So Freddie Mac is the other agency that I mentioned. 5 years of IO. What that means is 5 years of interest only. And so what that does, in case you're wondering, what it does is that it allows us to have more cash flow. Instead of having the paying the principal, we're just paying interest. So 5 years of interest only, 3.78% is the interest rate, and it was an 80% loan to value. Approximately 6 million equity raise, value added property as well. And projected returns on this deal was a little over 95% and 10% cash on cash. Our latest deal that we have, this is a deal that we closed on just recently, actually in February, 264 units, 23 million purchase price. This also was a Freddie Mac loan. We're able to get 4 years of interest only, 3.8% interest rate, 76% loan to value, 8 million equity raised on this one. This is more of a hybrid. And what does that mean? Pretty much what that means is that, you have a value add and then you have others that are more yield. This is kind of in between. So it was already a yield play, but there's some value add component to the property that we're able to implement. And so this is, we call it a hybrid. And then the overall projected returns on this one is about 86% and 9% cash on cash. And these returns are based on 5 years. All these projected overall returns are based on a 5-year hold.
All right, cool. Thanks, Juan. Usually we use these meetups as an opportunity to educate our audience about, different steps in the multifamily space, whether it's acquisitions, underwriting, property management. Some people are newer to this space, some people are more experienced, but I think, the growing theme, especially in this day, these uncertain times, is kind of how existing operators as yourself are handling the current situation with regards to, property management, dealing with tenants, your strategy with regards to capital expenditures that were on your pro forma, things like that. So I know you kind of alluded to some of these bullet points. Just want to go ahead and kind of give the audience a little more information as to how you as a team are navigating these times. And then Kevin, we'll actually open it up for questions for people who have any additional questions on the operations.
Sounds good.
Yeah. So thank you there. So obviously this is something that was thrown to us, right? It was like a curveball that nobody expected. This is, not only nationwide, I mean, this is worldwide, right? So it's just, one of those, unfortunate situations. But, out of this also arises opportunity. So, there's going to be some opportunities down the road that we may see in Q3, Q4, and maybe even going into Q1 of 2021. So, the best thing for us out there is to educate ourselves and to be ready, whenever those opportunities arise, because there will be some, how long or how many, that's another question. But yes, going back to this slide, pre-COVID, and currently, I didn't say post-COVID because we're actually still going through it. So it still is currently. So, just kind of to recap here, it's a, I have a side-by-side kind of comparison there. So pre-COVID, what we're doing is, we were, full on in CapEx improvements, right? So CapEx meaning any major improvements that we're doing to the property. For example, if you were doing roofs, or if you're doing leasing office or interior units or anything, exterior, those are all, major CapEx improvements. We were, pedal to the metal on that, right? Before the COVID-19 situation arose. But currently we've postponed those major improvements. Why? Well, a couple of different reasons. One is obviously we want to make sure that the staff is safe, right? A lot of these improvements that have to be done are interior renovations. And, a lot of the tenants are not, they don't feel safe, for people, crews walking in there, doing all these different kind of renovations. So we had to pretty much put a pause on that. Another reason is because, hey, this could last 2 months or could last, 6 months or could last a year. We don't know how long this situation will last. So we have to make sure that we postpone these renovations and maybe save these funds that we have, this capital that we have. And if things get a little rough down the road, then we have that capital to kind of, get us through this rough patch, so to speak. So a couple of different reasons there. Actually on a couple of the properties here in Texas, because we're actually reopening business here on Friday in stages. We're doing it, but we're going to start to reopen, open for business, and as far as the economy is concerned. And so we've began to start getting the bids again, right? To be ready to, hey, whenever we're fully open, we want to be ready to get going and kind of catch up where we kind of left off. So that's the first couple slides there. Or first couple of bullet points there, rather. The next one is, pre-COVID, we were full rent increases. So any interior renovations that we were doing, we had, full rent increases. So, whether that was, $50, $100, whatever, you name it, we were going all the way. And that includes the renewals, right? Because these renewals will also have rent increases. And so currently we're doing no increases on both the new leases and the renewals. And that is for, because of the same reason, we're trying to drive the number of people that are at the property, the number of prospects, and then our current tenants that we have, we don't want them to leave. So our thought process here is to keep our tenants that we have on site and don't let them leave, right? But there's a couple of different things that have helped there. One of them being that people don't want to leave. They're not looking to get up and move, especially during these times. And so that's been a rewarding, piece there. But the other is, we're not charging them an upgrade fee or an upcharge there. So, people are more willing to stay at the property. Moving on, the fees that we have at the property. I mean, we're moving forward with that. I mean, we had like renewal, like I said, application, late fees. There's a bunch of miscellaneous fees that we had there. And currently we have stepped back away from that. So renewals, again, late fees on a case-by-case basis. We didn't put that out there to the masses so everybody can see. It was more of a, hey, if we have good tenants that are been paying on time, then we want to make sure that we take care of those tenants. And, if they ask for it, then we can work with them and waive those late fees. We don't want everybody to do that because people will take advantage of it, right? So if we say, hey, we're going to have no late fees here for this month, then people will take advantage of that. And that's the last thing we want to do, because they're still responsible for their rent there. So normal concessions and bad debt was pre-COVID-19. Concessions meaning, hey, if we have like $50 off for the first month or $100 off for the first month, that's a concession, right? That's what we call a concession. Bad debt meaning where people are not paying their rent, right? And it has to go to either collections or we have to collect it ourselves from the tenants. That's the definition of bad debt, more or less. And so now with currently what's going on is we've had to increase our concessions, both to attract new tenants, but also to be able to keep our existing tenants, like that we can, continue our collections as well. So we had to increase our concessions, which increases your economic vacancy. And then the bad debt, that's another thing that definitely has increased because there's been people that are not paying rent or it's much harder to be able to collect from them. Although I will say that our properties are over 90% in collections from March. So we're actually closer to 95+%. In comparison to March. So we're actually not doing too bad there, Next one right there was the in-person leasing was the main leasing strategy. Yes, we did do online and there was a lot of traffic that we were able to get that way, Facebook marketing, Instagram marketing, those type of platforms. But a lot of it was, just, drive-bys, people walking into the office, doing that type of leasing. That pretty much has gone away. Now what it is virtual leasing. So in regards to that, we've had to implement some, on the actual websites, you click on the website, you have to make sure that we have a virtual tour and leasing. So all that has to be a seamless process for the tenants to where they're able to be able to view the unit, view the amenities, and then also be able to apply online, right? And then at the very end, all they do is pick up the key from the office. So we're trying to minimize the interaction that they had with the actual staff, right? So it definitely has changed at the property level, right? Another thing there was quarterly investor distributions for the properties that were able to do that too. We were doing quarterly investor distributions, but then we had to postpone that now, and that's TBD, right? To be determined, depending on how long this goes on, right? So we're hoping that this kind of gets behind us sooner rather than later, like that we can get back on track on that point. And last but not least, there was the community amenities were fully open, obviously, pre-COVID, and then now we've had to close these to be able to minimize any transfer of the coronavirus there. We did put a bullet point there for subject to change. It is currently 2020. All of these are obviously subject to change. Once this is kind of behind us, and we start to remove some of these in our business plan.
Cool. Kevin, do we have any questions? So we want to pitch over to Juan from the audience.
Yeah, we have a couple in here that are pretty relevant to the topic. So Eve White asked, in terms of these operational measures, are they working? And do you have like a high percentage of non-payment due to unemployment or reduced salary impact currently? Yeah,
those are very good questions. So I'll go to the first one or the second one first. I mean, so as far as the number of people that we've had not necessarily paying, we've had a few. I wouldn't say it was an overwhelming majority. I would say less than 5% of people that have actually reached out to us for payment plans, and we've been able to help them out with the giving them government assistance, helping them apply, doing all those type of things to be able to help them out. And so we've been able to really get through that. And so it's been a minimal impact. Has it worked? Yes, definitely. It definitely has worked. This is something that pretty much everybody across the board is going through. And one of the things that we do as well is we have calls with other guys, other operators, other owners, in a certain market. I actually had a call last week, and this was one of the guys was with Greystar. So it was actually a call with their one of their main guys at Greystar, and these are one of the largest, if not the largest, property manager in the nation, right? And so we had a call, like it was a virtual call, kind of like the way we're doing it here. And so we were just sharing information, what's working for you guys, what's not working, what we recommend. So pretty much everybody's doing the same thing that we're doing as well, right? So this is not something that we're, I guess, doing it by ourselves. It's kind of something, I guess you could say the majority of the properties are doing as well. And it definitely is working. And so I would say that April collections wasn't as bad as we had expected. May, that's to be determined. I don't think that, it'll be as bad either because we've already had a lot of prepays. So one of the ways that we've been able to kind of minimize that is by offering raffles, right? So for example, we had a raffle for our properties for May. If you're able to pay on time in full by the 1st, or by the 3rd rather, then you get entered into a raffle. And so people are excited about that. They take advantage of it. And so we had a lot of prepays already for May, right? And we're still in April. So you have to kind of do things that could try to work, right? So that's what we've been trying to do, try to be proactive in these cases,
Awesome. Thanks, Juan. In terms of the May rents, do you have any expectations in terms of what you're seeing and what your counterparts are seeing eventually?
Yeah, that's a very good question. So, as I mentioned right now, so for May, we've already had a lot of prepaids, that will be going to their May rent. One of the things that we also are taking advantage of, not in a bad way, but in a good way, is the unemployment, right? Because a lot of people are actually making more income during this unemployment phase through the COVID-19 than they were pre-COVID, right? So a lot of the tenant base that we cater to is more of the workforce housing. And so a lot of these workforce housing tenants are actually currently making more in their checks than they were pre. So what does that mean for us? That means that, hey, let's push on these for the people that actually need the help. Yes, let's work with them and help them in any way that we can. But most of these people are going to be making more money, right? And so that's a whole nother subject that we can get into. People can take advantage of that and whatnot. But for us so far, and again, we're not in May yet, but so far it's been good. But again, we're not in May yet, so that's that can change quickly.
Definitely. Some of the questions from John was, what percentage vacancy rate do you anticipate seeing? I know it's a little bit hard to see in the crystal ball, but are you calculating any of those percentages into the pro forma, or how are you guys adapting to that potential May and June change?
Yeah. So definitely. So, that was another reason why we wanted to kind of hold back on some of these major CapEx improvements, because, hey, we may get into a situation where, hey, we need to use some of these funds, right? Because we don't have the collections, our vacancy is lower. So we have to be able to pay our debt service, which is, our mortgage, right? We call it debt service in the commercial real estate space. So we're going to be able to pay that. And so you have to get it from somewhere. And that's, the CapEx, right? Usually is a CapEx. And so, at this point, it really is hard to say, how, June and July is going to look like. I would say that, with Texas reopening, it looks like it's going to be a good thing. Hopefully it is a good thing. My fear is that, we're opening too soon. That could be something where, hey, here's another wave of COVID-19, and then we have to do this all over again. And the second round is even worse than this current round, right? That's always a fear that it's unknown. But right now the best thing we can do is keep pushing forward, and keep monitoring it on a daily basis. And that's what we do. We check our collections on a daily basis to make sure that, what we can do to improve and what we can do to keep collecting on those rent payments.
Awesome. Thanks a ton. One last question from this main section. Pam was asking the raffle prize, what are you offering that has encouraged the tenants to pay on time?
Yeah, that's a good question. So we have a couple different ways of doing it on a couple different properties, right? So some of the properties we're offering $250 and $250, right? So what it is as long as you pay on time, your next month's rent in full, then you get entered into this raffle. And this raffle will give you credit back on your May rent. And so, people are excited about that, right? So we've done a couple different ways. One is, like I said, $250. So like a couple people get to take advantage of that. And another property has been like $500, right? $500 is a grand prize. And so that's more exciting for some people, right? As well. Another thing that we've done besides that raffle is for the people that didn't win, right, that don't win that grand prize, which is that raffle, we're giving them like a $10 gift card, right, to like a Walmart, right? Because everybody goes to Walmart, especially our residents, our tenant base. We're giving them like a $10 gift card like that. Hey, you paid on time. Thank you so much. We appreciate you. Here's this $10 gift card as well, right? To show your appreciation. Because really at this time, yes, that increases our concessions. Going back to the fourth bullet point there, that increases our concessions, but you're also, keeping these tenants happy. And, for us to give up, just a little bit in return for, if their rent payments is $800, $900, $1,000, and we're giving them $10, I mean, that's nothing. I'll do that trade all day long, every day, So, those are the kind of things that we had to do during these times. Maybe pre-COVID, we didn't have to do that, especially if you had a higher occupancy and, things are moving well, then you can decrease your concessions. But right now, this is when you have to get a little more creative and just do those kind of things,
For sure. Thank you, Juan, for the wisdom. There's a couple other questions in here that may not be tied to this operation side. I'll kind of let you determine if you want to answer them now or maybe towards the tail end, but a couple are regarding, the renovations, labor costs, CapEx numbers, and then there's also projected IRR, and then some related to landlords banning criminal background checks. So these seem like they could be more general questions. We may want to save for the end.
Yeah, we could definitely save these for the end. These are a little bit more general, but yeah, I'll be happy to answer those questions for sure. And
okay.
and we can get to those for sure.
Perfect. I'll hold off on those questions, and if you want to move on to the next section, let's go ahead and do that.
Yeah, so Juan, we were talking about it yesterday, right? Your underwriting strategy now moving forward, especially when we're looking at a couple deals together, the underwriting, was pretty conservative then, given where we're at in the market. But now that the market's a bit more uncertain, I'm sure a lot of people are looking to see how experienced investors like you are looking at new opportunities. I know you're currently active in the market still, and so kind of want to get your feedback based on what your new acquisition strategy is looking like.
Yeah, no, for sure. So again, I kind of divided this like in pre-COVID and currently, right? Things have definitely changed for us as as our underwriting criteria is concerned. So the pre-COVID-19, we had regular rent increases of 2 to 3% in year one, right? So that means that we're going to go in there, we're going to renovate the property, we're going to increase rents. It's going to be about 2 to 3% year one. So we try to always be conservative from the get go anyways. You can argue that that's already conservative, pre-COVID-19. I've seen a lot of other groups and operators and even some colleagues do 3, 4, 5, 6% year one, which is fine. It depends on the opportunity, it depends on the property, depends on the market. We always kind of did 2 to 3% year one, and then we kind of flattened after that, like a 2% thereafter, right? So now currently what we're doing is we have a 0% rent increase year one, and then maybe a 0 to 1% year two, and then a 2% thereafter, right? So the thinking behind that is we can't assume that we're gonna get more any increase like for the rest of the year, right? So our thinking is, okay, this could continue for the next 6 months, it could continue for the next 9 months, it could continue for the next 2 years. We don't know that. So for us to be able to underwrite a deal, we have to make sure that we underwrite a deal in a more conservative manner. And if it works out there, then great. It's probably a deal, right? So we have to make sure that it works for us in those under those categories, right? And so this is for us. This is not what other guys are doing. This is just what we are doing, right? So total income. So the first one was the rent increases. Total income is more of it includes the other income, right? So other income could include like parking charges. So like covered parking, reserved parking, laundry income, all these other, income sources, late fees, all those type of things. So total income plus the rent that we have there for year one was about 5 to 7%, right? And then currently we are doing a flat, right? So we're actually, it could be even lower than a flat. And that's because we can't account for those type of other income sources, right? Because during a crisis, what do most people do? If they don't need covered parking, then they try to get away from covered parking, right? If there's a spot over here that's not covered and I can save myself $30, then I'm going to go do that, right? And then the same thing with reserve parking, right? Same exact kind of thing. So another thing that we cannot account for is the late charges, right? So we already given up some of these late charges today already. So we can't assume that it's going to be there. So anything that you're showing in other income on the pre-COVID side, we have to make sure that we reduce it. And so what it does overall is that it flattens your total income for year one. Hopefully that makes sense for everybody. If it doesn't make sense, please, feel free to send us some questions on that as well. On the reversion cap. So again, here, if it doesn't make sense, please feel free to send us any questions on that. But we have a cap rate that we buy the properties at, and then we have a reversion cap, which is where you expect to sell the property at year 5. And so the higher that the number is, then the more conservative that you are. So we always try to be anywhere from 50 to 100 basis points above the in-place cap rate that we purchase it at. Unless we're buying the property at like a 10 cap, then that's not a realistic number. The realistic number was probably around 6 to 7% cap rate. So then, it'll be actually reversed on that case. But currently what we're doing is anywhere from 100 to 150 basis points. And what that means simply is 1 to 1.5%, right? In other words, or on the pre-COVID, 0.5 to 1% increase. So we're trying to be more conservative and saying, hey, things are going to get worse, right? Or they're going to continue to be in a bad situation here. And also because the cap rates are actually going to increase. I think they're going to increase, a little bit there. And so we have to make sure that we keep that same distance, so to speak. So if they increase 50 basis points, then we need to make sure that we have that leeway over here on the current side. So moving on, there was the pre-COVID, we had replacement reserves that were required of 200 to 350 bucks on average per unit per year. And these replacement reserves are basically funds that the lender requests to hold back in case things go wrong at the property, right? Like an emergency fund that they request us to hold back, right? So we have to make sure that we account for that. Now the lenders have actually tightened up quite a bit there. So on the capital market side, there's a lot of lenders that have actually backed out. You have life co companies; those guys are pretty much out. CMBS market is out. There's a lot of guys that are out. Some of the banks are usually in. Those guys are still in. The agencies such as Fannie and Freddie, those guys are still in. But the agencies are actually requiring 12 to 18 months worth of debt service, which is your mortgage. So that's principal and interest. They're asking for taxes as well. They're asking for insurance, and they're asking for replacement reserves. So which one is 12 and which one is 18 months? That really depends on your loan amount. So if your loan amount above 7 million, then they're asking for 12 months worth of debt service, taxes, insurance, and replacement reserves. If your loan amount is under 7 million, then they're actually asking for up to 18 months. So that's something that we've had to add into our underwriting. So whereas before we didn't have to do that, now we have to do this. And so what does that do? That means that we have to raise that much more equity for our deals. And so what does that mean for the returns? That means the returns go down, and so this is something that we have to hold in escrow for anywhere from 12 months to 3 years, for 12 to 36 months. And so, yes, we can return that capital back to our investors, but, during this 12 to 36 months, it's just reducing our returns. So that's something that's really, really important, that we make sure that, we have to account for that. And actually, a side note real quick, we actually had a deal that was under contract, I would say about a month ago. And right before we apped, one of my friends who's in the capital markets, he texted me, he said, "Hey, have you heard about this?" And we're just about to app. And I was like, "No, I haven't heard about this." And he was like, "Yeah, man, you're going to have to account for 18 months here of debt service, taxes, insurance, and replacing reserves." And that killed the deal right then and there. But luckily for us, we were able to add clauses like from the very beginning into our contract that pretty much protected us in case something related to COVID-19 changes, including the financing terms. Then we can postpone the contract, or we can get out of the contract, right? So at this time, it's actually been postponed until things actually get better. So that's just a side note for people to know. It's very important that you underwrite for this. Moving on here, pre-COVID-19, we had 75 to 80% leverage, 3 to 5 years of IO. Now we're seeing quotes come back from 65 to 75% leverage and 2 to 3 years of IO. So not only are we having to raise capital in the bullet point above that, but now we're having to raise even more capital because we're getting less leverage. So deals are actually going to be harder to make sense. So what does that mean overall? I mean, pretty much what has to happen is the cap rates have to go up a little bit, right? If the deals if the sellers want to make deals and transactions, then something's gonna have to give. And so we're already seeing that a little bit, and I can go on to that if you guys like on another towards the end there too. Pre-COVID, our focus was mainly on B and C assets, and we're continuing to look for B and C assets. That's not going to change. But even before this, we were looking at some of the A assets. I will call it maybe A minus B plus assets. And so, that's going to be a continued focus for us during this time and even moving forward. A reason for that is because, for us, based on the research and information and data that we've seen, the B class assets are some of the most resilient. If you have an A class asset that's not, the tenant profile is not, willing to pay, which they will, but in most cases they're looking to save some money on their rent, they can move to the B class assets, right? And so the B class tenants, they don't like to I guess, reduce their style of living. And so overall, what we found based on our research, the B class assets are the most resilient. And so we're going to be looking at those. Although I would say that we will be looking at the C class assets, but it's going to be a majority focus on the A and the B class assets, with the majority actually being on the Bs. Moving on here, with deals that we presented to investors, before, we had to sell our track record, right? So we had to, tell investors about us, sell the track record, sell the geographical location. So this deal was based in Dallas, Texas. This is why you should invest in Dallas, because of it's diverse and so on. And then also the physical assets to the investor. So this is a Class B deal. There's rent upside here. Those are the kind of things that we had to sell. But now we have to increase or include the current market, right? So it's becoming harder to be able to market to investors, and which in turn will be more difficult to be able to raise that capital, because you have to sell the investors on the current situation with COVID-19. There's a lot of uncertainty there. There's fear. And so, a lot of investors are kind of sitting on the sideline, just kind of waiting to see what happens there. Right. So it will become more difficult. So, but yeah, those are some of the things that we have to take into account whenever you're looking at the deals.
Awesome, Juan. Thanks for sharing, man. A couple questions on this particular underwriting section. So Leon asked, I'm assuming you're not getting close to pre-COVID asking price. Are sellers adjusting to the new reality, or are they mainly waiting till the market improves?
Yeah, so that's a very good question. So we've had a little bit of both, right? So as Jaime mentioned earlier, we're still in the market. We're still looking at deals. We're still submitting offers, actually, right? So we've had a little bit of both. So we've had guys that they understand the current market, but they still want their price, right? And that could be mainly because they need to hit a certain return, right? Because they have their debt service, and they need to get this return here, this price here, to be able to make their numbers and their investors, happy, right? Otherwise, it's not going to work, right? They won't take a loss. So what those guys are doing there is they're just simply holding back, and they're gonna wait until things kind of get back, back to quote unquote normal, right? On the other side, we've had some guys that understand the situation, and they need to make a sale. They need to sell, and so they are willing to adjust their pricing, right? And they understand this. They see the same thing that we're seeing. All these things that I showed here, sellers see that too, because they're investors, they're owners. They're always looking at the market as well. So they understand what's going on out there, in the capital markets. They understand the uncertainty that there is with not only private individuals and investors, but also a lot of the private equity sources, family offices, those kind of guys, they're also kind of like on the sidelines waiting. Everybody's kind of waiting for that first guy, right, to take action. So we've seen guys adjust their pricing as well, but the numbers still don't make sense. Once you account for this fourth bullet point on the right side, then it becomes so much harder. And then you account for the fifth one, which is the lower leverage. It really doesn't, it doesn't help, right? Because it still doesn't make sense. So we've noticed that the offers are coming in much lower than they would have, say, 4 months ago, 5 months ago, right? So a quick story on that. We have on our Dallas property, one of our Dallas properties, there's a deal that's nearby, right? So the broker who we transacted for that deal right away sent us another deal, right? And we've had this deal for a year, right? And then he said, hey, we have the seller, it's 3 owners, they're 3 partners. One of them wants to sell. We have to get with the other ones, but what do you think? Are you interested? And I was like, yeah, give me some numbers. So then he got back with us in a couple months later, and then he's like, hey, so I got the answer from the sellers. They're interested in selling, but they're still unsure if they want to sell now or they want to sell later. And I was like, okay, well, what are they looking for? Well, they want this number. Okay, well, I need the financials. Give me the financials. Like that, we can make an offer and see where we come out at. And then, but they kept dragging their feet. And then here we came to the end of the year, and they were like, hey, are you guys still interested? And we're like, yes, we've been waiting for you guys for like 6 months. What's going on? And then they're like, okay, well, we're going to send you guys the financials finally. So they sent it to us in March, last month. They sent us the financials. Now where the property could have made sense at their asking price, 6 months before, it wasn't even close. So it was about half of their price. And so this is a smaller deal. They're asking for like 9 million, and my offer was like around 5.5. And so I told the brokers, man, these guys were over here dragging their feet, man. If they would have just took action, in 2019 when we started this conversation, we probably would have paid 9 million for this deal, right? Or give or take. But now I can't even come close to this. So, just forget about it, man. If those guys want to come to this price, then we'll talk. If not, then, he's just got to wait on it and sit on it. So that's kind of what they did. They're just sitting on it. So, sellers need to know that, hey, things have changed. We're in a different market. It's become more of a buyer's market than it was on the seller side. It was the seller's market forever. Now we're seeing guys, including ourselves, put up no hard money. Whereas before, we put up 1% to 2%, 3%, in some cases, hard money day one. Now we're putting no hard money. There's financing contingencies. There's contingencies for due diligence. And why is there a contingency on due diligence? Well, again, the deal I talked about earlier, the residents don't want people to go into their units to do due diligence because they're afraid of COVID-19. So there's a lot of things that have changed that the sellers need to be aware of. We definitely have changed into more of a buyer's market. So again, that's why I say, there might not be opportunities today, but there's going to be a window of opportunity where people need to take advantage of, while everybody's running in one direction, we have to be the ones that run against that direction and go the other way, So that's kind of the way I see things, at least,
Thanks for sharing, Juan. Another question regarding some of the numbers by Luke. He's asking, current underwriting in 2020, now with all of the lending changes, were you expecting to see like cash on cash, the IRR, return on equity? What are those numbers looking like now?
Yeah, so they're definitely gonna be lower, right? I think that really depends on the opportunity in the deal. The debt has a lot to do with it. What kind of debt that you're getting, how much leverage you're getting. But I guess to sum it up, I would say that we're expecting our numbers to decrease for sure. Where before we were looking anywhere from 13, 14% plus IRR. Now we have to look at 13 and maybe below, right? If we want to transact in today's market, then it may be a little bit lower, but we're certainly trying to push for a price point that makes sense for us, where we can still retain that 13, 14% plus percent IRR, cash on cash. That's again, we always shoot for 8 to 9% average annualized, and so that could also decrease because of the same reasons that we're having a flat total income. We're having a flat 0% increase for pretty much year one and year two, right? And so it definitely, that's where you get a lot of your cash on cash from is those, your rent, your other income and those type of things. But yeah, on the debt side, we have seen there's still competitive rates, whereas, before, we're in the high threes, we're still in those high threes, give or take. And so we have to make sure that we underwrite for a little bit higher. We always underwrite for a little bit higher because the time you app to the time you actually close, it changes a lot, right? And so we have to make sure that we're always conservative on that aspect as well. Yeah.
Hey, Juan, there's
Awesome.
one question that was sent to me privately. I think they meant to send it to everyone. And Jeff asked, do you foresee the real estate price to go down in coming months?
Yeah, that's a good question. So yeah, that kind of goes back to what we were discussing on the cap rates. If the cap rates do increase from a direct result of the what's going on here on the lender side, there's going to be a lot of capital out there just kind of sitting on the sidelines. The cap rates increase, then the pricing has to decrease, right? Those go hand in hand. And so yes, I would expect it to decrease. How much? That's a whole nother question, right? That's definitely to be determined. It definitely is to be determined on market by market, on asset class by asset class, on classes within multifamily themselves, A, B, and C. There's a lot of factors there that can determine how much the pricing adjusts. But yes, I do anticipate a little bit of a price adjustment. I will say also, I try to keep up with the latest and greatest information out there with all the capital markets guys and the brokers and all that good information. There's a lot of capital out there on the sidelines that's kind of waiting, but then there's a lot of guys. I've talked to a lot of brokers. I've talked to two today as well. But there's a lot of guys out there that are calling the brokers now and saying, "Hey, man, I was on the sidelines for the last 5 years, man. I've been waiting for this exact moment. I'm sitting on a pile of cash. Let me know when you have a deal. I'm ready." So you're going to be competing against those guys as well, right? While we're kind of afraid to, what's going on, we don't know. There's a lot of guys out there that are sitting on a pile of cash and they're ready to invest like today, right? So I think that yes, we could see a little bit of a decrease in pricing, but I think it's still going to be a competitive market either way, especially if we reopen sooner rather than later. Then I think things will we're going to have a hiccup there, but I think things will pick up for sure.
Juan, so you don't have a crystal ball to tell us how much prices are going to drop?
No, for sure. I don't have that, man. But yeah, I hope they drop a lot, man. I mean, our deals, I say that, selfishly because our deals, we have long-term debt. We're not planning on selling them anytime soon. So, for us, we're good, right? And we're also buyers. So, if we're able to buy deals at a much lower price, then that's a win-win, right? Obviously for the guys that have debt that's due, in the next, 12 to 18 months, it's going to be a much different situation for those guys. Hopefully they're able to get out of their deals and sell or refi, one of those things. They have to do something, right? But yeah, I mean, if we could drop, that'll be awesome. I mean, we're ready, we're ready. So that's, I think everybody, whether you're looking to learn or you've already learned a lot and you're just looking to take action, I think, this is, these are the kind of moments that we're waiting for, that we've been waiting for, that we talk about. There may be a big opportunity here or maybe just a small window, but either way, I think, people need to take advantage of it because these type of moments don't come around often,
100%. Another question by Yuki is purchasing a house right now under the current COVID situation. How do you feel about that? No, it's on the topic.
Housing, like you're saying, like a house, like a residential house.
Residential.
Yeah.
Yes.
So I think, I mean, personally, and this is just for me, right? I'm not, I don't know what that person's financial situation is or what's going on, right? But I would say wait. I would say that based on past experiences, like in 2008, always whenever our last crash happened, right? That was the beginning of 2008, right? Some people say late 07, 08, whatever, right? It was an 08 timeframe, but we didn't start seeing like the lowest in pricing until like 09, 2010. So a lot of that is because, the banks have to go through their process. They have the forbearance process, and then, they have, short sale, they have, foreclosure. And then that's whenever those numbers start to increase, if we get to that point, then that's when the pricing starts to drop, right? One thing that we have seen from some of the lenders, like Chase, for example, is they're already requesting for you to have a 20% down payment, right? And they're wanting your credit score to be, crazy high and a 20% down payment, right? Why is that? That's because they want to reduce the risk, right? They want to transact with the buyer that's going to be less risky because they don't want to go to that situation of foreclosure, right? They're not in the business to hold properties. They're not in the business to hold notes. All they do is service them, right? And so, I think personally, if it was me, I would say I would wait. I think, if there's gonna be an opportunity, they'll come around. I don't see the interest rates, moving up, in anytime soon because, we just frankly can't. We cannot. We have to keep the economy moving, and we have to have that consumer confidence to be up, right? If we start increasing, then there's gonna be less spending out there. People are gonna be holding on to their funds, their capital, and that's why we have these housing. And that's one of the reasons to stimulate the economy, right? So long story short, I would say my personal experience, I would say wait. Again, that's just me, and hopefully there's more opportunities where you can take advantage of buying a house at a much lower price point if that's your desire.
Awesome. A couple more questions. So Alex Coe is asking about renovations and cost of labor. So, with COVID shutting things down, are you seeing bids come back higher? And are you seeing the CapEx and labor costs increasing?
Yeah, that's a very good question. We have not yet received any latest bids. Since COVID-19, we had the pre-COVID-19 bids, and some of these we had already approved, and those vendors were actually getting ready to go out there, and we actually called them and say, hey, we need to put a stop to this. Let's postpone this to be determined. And they agreed. They understood the situation that we're in, not only us but them and everybody out there. So we actually today is one of our busiest days. We have a lot of our asset management calls. So we had discussions today of getting these new bids to some fresh bids, right? Because some of these were from a month and a half, 2 months ago, right? So now we want to get some fresh bids and see what's going on. So I'm sorry I can't answer your question there, but I think that my feeling is that we may not see them higher because people will still want to do business, and yes, they lost some revenue there, but they still want to be able to earn your business. And some of these most of these general contractors and vendors, they are able to win a bid by being the lowest price, not the highest priced, right? So we always get several bids and wouldn't always go with the lowest priced, but that definitely does help, right? So that's what I would say on that.
All right, Kevin, one last question so we can wrap this up.
Yeah, let's go ahead and let's see. So this is more about like worst case scenario. If the numbers, unemployment stay or get worse, or stimulus runs out, what's the strategy to keep these assets afloat?
Yeah, so that's a very good question. If that runs out, then we're all in for it, right? No, I think for sure, if that runs out, then we're going to be in a tough situation, right? Because really the biggest thing for us is to understand and keep up with the employment, right? If as long as we have unemployment checks coming in, then it'll be fine. Once we start reopening the economy, then these unemployment checks, they're not going to be there forever, right? I think the current administration, whether you like them, hate them, that's not my business. I think they're going to do their job of saying, okay, we have a month left. We have all these jobs, X number of jobs that have come back. You're going to have a month left in your unemployment. So, take advantage of it while you can, but it's not going to be available for a month from now. So pretty much get your butt back to work is kind of the way it's going to be, right? So really, it's all going to be based on the economy, right? If we can reopen the economy, then we're going to be in a good shape. If not, then it's going to be tough. The thing for us is we have stress tested our deals. As soon as this happened, we stress tested our deals. We're able to hold on to our properties at a much lower economic vacancy. So, the property will still be able to pay our debt service. Some of these are, 40%, 50%, 60% economic occupancy. So we're able to still withstand, a big hit. But, programs like the PPP program, the Paycheck Protection Program, that definitely helps. We've been able to qualify for those. That's going to pay our payroll. And so what that does for us is it reduces our expenses as well. So there's programs out there that we can take advantage of, and we definitely have taken advantage of them,
All right, Kevin, why don't we, wrap up?
Real quick, guys, I got a quick comment. It was the first time that I set up the Zoom where you have to register. So I don't know if Zoom stores the emails, but just to be safe, if you guys want to stay in touch and you guys want to hear about any future deals that any of us may be a part of, you're interested in partnering up, whether it's as a GP or as an LP, if you guys want to email Kevin, you guys can see his email here, kdugan@altusig.com, and just send him your email and just kind of make a note that you guys are interested in, just being staying in the loop in regards to future deals, just to make sure, because I don't know if we have your emails right now. So again, those of you that want to stay in the loop of things, just go ahead and email Kevin. He added his chat here on the chat, so you guys can copy and paste.
All right, thanks, Jorge. And so just a little bit, just kind of contact info. Feel free to jot it down. If you want to reach out to us about any specific questions or get in touch with Juan. We didn't put his contact info here, but we'll if you send us a note, we'll make sure to circulate that around. So I think Kevin, right? Next meetup Tuesday, May 26th, depending on how the current situation is, most likely virtual again. And very similar to this one, we'll definitely have a good guest speaker just like Juan.
And then Juan, we know that your time is very valuable, managing over 500 units on a GP. So thank you for sharing your valuable time, your expertise. All of us here definitely appreciate your valuable time.
Hey, once again, I appreciate you guys. Jorge, Jaime, Kevin, I appreciate all three of you guys for having me here. Sharing, hopefully some information for those out there that are looking to get started or looking to take that next step. And I want to thank everybody out there for listening as well. I appreciate your time as well.
Awesome. Well, I think we can wrap it up.
Anything else, Kevin, Jaime, that we need to share?
Nope. We'll be in touch for our next one.
Stay safe, everybody.
All right, guys. Have a good night. Take care, guys. Bye-bye.
Bye, everyone.